Look, I need to be straight with you about something that's happening right now in the markets. While everyone's celebrating stock market gains and patting themselves on the back, there's a massive shift occurring that most people are completely missing. And by the time they figure it out, it's going to be too late. Gold just surged 50%. Not over a decade, not over 5 years. In a single year, that's the strongest rally we've seen since 1979. Let that sink in for a moment. The last time gold moved like this, we were in the middle of an economic crisis that reshaped the entire financial landscape. And here's what nobody's talking about. This isn't just some random price spike. This is institutions, central banks, and the smartest money in the world telling you something critical about what's coming. But here's where it gets interesting. While gold is making this historic move, you've got financial media still pushing the same tired narrative. Stocks for the long run. Don't fight the Fed. The market always goes up. And sure, maybe that worked for the past 40 years. But what happens when the entire foundation that narrative is built on starts to crack? Let me show you what's really happening behind the scenes. Central banks around the world are accumulating gold at a pace we haven't seen in modern history. These aren't retail investors panic buying. These are the institutions that literally print money, and they're converting that money into physical gold as fast as they can. China's central bank has been buying every single month. The Reserve Bank of India is stockpiling. Poland, Singapore, Turkey, countries that historically held minimal gold reserves are now loading up like they're preparing for something. Now you might be thinking, okay, but central banks do weird things all the time. Why should I care? Here's why. These institutions have access to information you and I will never see. They sit in rooms with finance ministers and treasury officials. They know what's happening with currency agreements, trade deals, and monetary policy before it hits the news. And when you see them all moving in the same direction simultaneously, you need to pay attention. Because here's the thing about gold that makes it fundamentally different from stocks. When you own a share of stock, you own a piece of a company. That company's value depends on earnings, management decisions, economic conditions, consumer behavior, dozens of variables that can change overnight. When you own gold, you own something that's been recognized as valuable for 5,000 years. It doesn't depend on a CEO making smart decisions. It doesn't depend on quarterly earnings reports. It doesn't depend on whether consumers are spending money. Gold is the ultimate form of financial insurance. And right now, the premiums on every other type of insurance are skyrocketing because the risks are becoming impossible to ignore. Let's talk about what's happening in the stock market that should concern you. We're seeing valuations that historically only appear at major market tops. The price-to-earnings ratios on major indices are stretched to levels that preceded every significant crash in modern history. In 2000, right before the dot-com bubble burst, we saw similar valuations. In 2007, before the financial crisis, same thing. And here we are again, with everyone convinced this time is different. But it's not just valuations. Look at what's driving stock prices higher. It's not organic economic growth. It's not companies generating massive profits from selling products and services. It's financial engineering, stock buybacks funded by cheap debt, accounting tricks that make earnings look better than they are. And most importantly, it's the expectation that central banks will keep printing money forever to prop up asset prices. That last part is crucial, because for the past 15 years, every time markets started to wobble, central banks stepped in with more stimulus, more quantitative easing, lower interest rates, whatever it took to keep the party going. And investors got conditioned to believe this would continue indefinitely. They called it the Fed put, this idea that the Federal Reserve would never let markets fall significantly. But here's what changed. Inflation showed up. Real inflation, not the carefully managed 2% kind that central banks love. The kind that makes groceries cost 30% more. The kind that makes people angry and politicians nervous. And suddenly, central banks couldn't just print unlimited money anymore without serious consequences. So now we're in this bizarre situation where central banks need to keep markets happy, but they also need to fight inflation. And those two goals are fundamentally incompatible. You can't print money to support asset prices while simultaneously trying to reduce the money supply to fight inflation. It's like trying to drive with one foot on the gas and one foot on the brake. This is where gold becomes critical. Because gold doesn't care about this contradiction. In fact, gold thrives in exactly this type of environment. When confidence in currency management starts to crack, when people start questioning whether central banks can actually navigate these impossible trade-offs, that's when gold shines. And we're seeing this play out in real time. Look at what happened when tariff uncertainty increased. Gold spiked. When there were concerns about banking stability, gold spiked. When geopolitical tensions escalated, gold spiked. Every single time there's a crack in the facade of everything is fine, money flows into gold. But here's what makes this moment different from previous gold rallies. In the past, gold moves were primarily driven by retail investors and speculators. People buying gold coins. Small investors adding gold ETFs to their portfolios. This time, the buying is coming from the top. Institutional investors are allocating to gold in ways they never have before. Pension funds, sovereign wealth funds, family offices managing billions. They're all increasing gold exposure. Why? Because they're looking at the same data you and I can see, and they're reaching an uncomfortable conclusion. The stock market's performance over the past decade has been artificially inflated by unprecedented monetary stimulus. And when that stimulus inevitably has to be reduced or reversed, there's going to be a reckoning. Think about it this way. If you're managing a billion-dollar portfolio and you see central banks around the world buying gold aggressively, what does that tell you? It tells you that the people who control the monetary system don't fully trust the monetary system. That's a pretty significant signal. Now, let's talk about something most financial advisors won't mention. The stock market's returns over the past 40 years have been exceptional, but those returns happened during a very specific set of circumstances. Interest rates fell from double digits to near zero. Globalization expanded corporate profit margins. Technology created entirely new industries. China's growth provided a massive tailwind for global companies. How many of those tailwinds still exist? Interest rates can't go much lower from here. In fact, they've been rising. Globalization is reversing as countries prioritize domestic production and security. The easy technology gains have been captured. China's growth is slowing, and their relationship with Western economies is increasingly adversarial. So, when someone tells you stocks always go up over the long run, they're basing that on a period where almost everything went right. What happens when those conditions reverse? What happens when instead of tailwinds, you're facing headwinds? This is where the conversation about gold versus stocks gets really interesting, because it's not actually about which one performs better in a vacuum. It's about what happens to your wealth when the underlying assumptions of the financial system start to break down. Let me give you a specific example. In 1971, the United States ended the gold standard. Before that, dollars were backed by gold. You could theoretically exchange your dollars for a fixed amount of gold. After 1971, dollars became purely fiat currency, backed only by the government's promise and the economy's productive capacity. What happened to gold prices after that? They went from $35 an ounce to over $800 by 1980, a 23 times increase in less than a decade. Meanwhile, the stock market went essentially nowhere during that period. If you were invested in stocks during the 1970s, you lost money in real terms after accounting for inflation. Now, I'm not saying we're going to see an exact repeat of the 1970s, but I am saying that when the monetary system undergoes fundamental changes, gold tends to be the asset that preserves wealth while everything else struggles. And we are absolutely in a period of fundamental monetary change right now. The dollar's role as the global reserve currency is being challenged in ways it hasn't been since World War II. Countries are conducting trade in their own currencies, bypassing the dollar entirely. The BRICS nations are discussing alternative payment systems. Central banks are diversifying away from dollar reserves into gold. This isn't conspiracy theory stuff. This is official policy being discussed at the highest levels of government around the world, and it's happening because the United States has weaponized the dollar through sanctions and financial restrictions. When you make the global reserve currency a political tool, you incentivize everyone else to find alternatives. Quick aside here, if you're sitting on a significant amount in retirement accounts, you might want to look into how gold IRAs work. I put together a free guide that covers how to get physical gold into your retirement account without tax penalties. It's in the description if that's relevant to your situation. Worth understanding your options. Anyway, back to what this means for your wealth. The challenge with stocks right now isn't just that they're expensive, it's that they're expensive at a time when the entire financial system is under stress. Corporate debt levels are at all-time highs. Government debt is spiraling out of control. The banking system is more fragile than most people realize. We saw that with the regional bank failures that happened recently. When you own stocks in this environment, you're essentially betting that all of these problems will be managed smoothly, that central banks will thread the needle perfectly, that governments will get their fiscal houses in order, that nothing will break in a significant way. Gold is the opposite bet. Gold is saying, I don't need everything to go perfectly. I just need this asset that's been valuable for thousands of years to continue being valuable. And historically, that's been a much safer bet during periods of financial instability. Let me show you something else that's fascinating. The gold-to-stock ratio, how many ounces of gold it takes to buy the stock market, is at levels that have historically marked major turning points. Right now, stocks are extremely expensive relative to gold. The last time we saw this kind of ratio was right before major market crashes. In 2000, at the peak of the dot-com bubble, it took about 45 ounces of gold to buy the Dow Jones. Then stocks crashed and gold rallied, and by 2011, it took less than 6 ounces of gold to buy the Dow. That's a massive wealth transfer from stocks to gold. We're currently back near those extreme levels where stocks are very expensive relative to gold. History suggests this doesn't last. Either stocks need to fall significantly, or gold needs to rise significantly, or some combination of both. And given everything we've discussed about central bank buying, institutional accumulation, and monetary system stress, which direction seems more likely? Here's another angle most people miss. Stock market returns are heavily dependent on a small number of companies. Right now, the so-called Magnificent Seven tech stocks account for a huge percentage of the market's gains. If you remove those 7 companies, the rest of the market has barely moved. That's not a healthy, broad-based rally. That's concentration risk. What happens if those few companies stumble? What happens if AI doesn't deliver the revolutionary returns everyone's expecting? What happens if regulatory pressure increases on big tech? Suddenly, the entire market's performance is at risk because it's so dependent on such a small group of stocks. Gold doesn't have this problem. Gold is gold. There's no key company that needs to perform well. There's no technological disruption that can make gold obsolete. There's no regulatory risk that can shut down gold's value proposition. And let's talk about the supply side, because this is crucial. Gold production has been essentially flat for years. The easy gold has been mined. New discoveries are rare and expensive to develop. Meanwhile, demand is surging. Not just from central banks, but from technology applications, jewelry markets, and investment demand. When you have flat supply and rising demand, basic economics tells you what happens to price. And we're seeing that play out right now with gold's historic rally. Compare that to stocks. Companies can issue new shares anytime they want. Stock buybacks can be reversed. The supply of stocks is essentially unlimited. New companies go public constantly. Existing companies can dilute shareholders. There's no hard cap on stock supply the way there is with gold. This supply dynamic becomes especially important during inflationary periods. When currency is being devalued through money printing, assets with limited supply become more valuable. Gold has a strictly limited supply. Stocks don't. Now I know what some of you are thinking. But stocks have dividends. Gold just sits there. Fair point. But let's examine that more closely. Dividend yields on the overall market are currently around 1.5%. After taxes, you're looking at maybe 1% real return from dividends. Meanwhile, gold has appreciated 50% in a year. Even if gold does nothing for the next several years, it's already provided more return than decades of dividend payments would have. And that's before considering that dividends can be cut, companies can go bankrupt, but gold remains gold. There's also this psychological aspect that's important to understand. When you own stocks, you're constantly worried about news. Earnings reports, economic data, Federal Reserve announcements, geopolitical events, everything affects stock prices. It's exhausting. You're always on edge, wondering if today's the day everything falls apart. Gold is different. Gold doesn't have earnings reports. Gold doesn't have a CEO who might make a bad decision. Gold doesn't have quarterly guidance. You can own gold and sleep at night because you know it's going to be there, holding value regardless of what happens in the news cycle. And in today's world, where news cycles are increasingly chaotic and unpredictable, that peace of mind has real value. How much is it worth to not constantly worry about your wealth evaporating because of some unexpected event? Let's talk about what happens in a real crisis scenario. Not fear-mongering, just looking at historical precedent. In 2008, when the financial system nearly collapsed, what happened? Stocks fell 50%. Real estate crashed. Corporate bonds became worthless. But gold? Gold held its value and then rallied strongly as central banks responded with massive stimulus. In March 2020, when COVID hit and markets went into freefall, gold initially dipped with everything else, but then quickly recovered and hit all-time highs while stocks were still struggling to find a bottom. The pattern is clear. In moments of real crisis, gold acts as the ultimate safe haven. It's the asset people flee to when everything else is falling apart. And right now, we're in a period where the probability of crisis is higher than most people want to admit. Think about the geopolitical situation. Tensions between major powers are at levels we haven't seen in decades. The risk of conflict, trade wars, financial sanctions, all of these create uncertainty that benefits gold and hurts stocks. Think about the debt situation. Government debt levels are unsustainable. At some point, there will be a reckoning, either through default, inflation, or financial repression. None of those scenarios are good for stocks. All of them are good for gold. Think about the demographic situation. Aging populations in developed countries mean fewer workers supporting more retirees. That's deflationary for economic growth, but inflationary for government spending. Again, challenging for stocks, supportive for gold. The more you examine the structural issues facing the global economy, the more gold makes sense as a core holding. Not as a speculation, not as a trade, but as a fundamental component of a wealth preservation strategy. Here's something else worth considering. The financial industry has a massive incentive to keep you invested in stocks. They make money from trading commissions, management fees, and financial products built around equity markets. They don't make nearly as much money if you just buy physical gold and hold it. So when you hear financial advisors dismissing gold, ask yourself, are they giving you objective advice, or are they protecting their business model? Because the data clearly shows that gold has been one of the best performing assets recently. Yet most mainstream financial advice still treats it as a fringe investment. This is the same industry that told people to stay fully invested in stocks in 2000 and 2007, right before major crashes. The same industry that dismissed gold even as it rallied from $200 to $1,900 over a decade. Maybe, just maybe, they're not the best source of objective information about gold versus stocks. Let's look at the actual numbers. Over the past year, gold is up 50%. The stock market, depending on which index you look at, is up maybe 15 to 20%. Gold has outperformed by a massive margin. Yet if you listen to financial media, they're still talking about stocks as the only game in town. Why the disconnect? Because acknowledging gold's outperformance means acknowledging that maybe the traditional investment playbook isn't working anymore. It means questioning decades of conventional wisdom. And institutions don't like to do that. But individual investors don't have to follow institutional thinking. You can look at the evidence objectively and make your own decisions. And the evidence is pretty clear. Gold is in a major bull market, driven by fundamental factors that aren't going away anytime soon. Central banks aren't going to stop buying gold. The monetary system isn't going to magically stabilize. Geopolitical tensions aren't going to disappear. Government debt isn't going to shrink. All of the factors driving gold higher are structural long-term trends. Meanwhile, the factors that drove stocks higher over the past decade, falling interest rates, expanding profit margins, multiple expansion, those are largely exhausted. Where's the next leg of stock market gains going to come from? Earnings growth in a slowing economy? Multiple expansion when valuations are already stretched? It's hard to see the path forward for significant stock returns from here. Compare that to gold, which is still below its inflation-adjusted all-time high from 1980. If gold just matched that previous peak in real terms, we're talking about prices significantly higher than where we are today. And that's without assuming any additional monetary crisis or loss of confidence in fiat currencies. The risk-reward setup favors gold dramatically. The downside is limited. Gold has thousands of years of history as a store of value. The upside is substantial. If we see any significant monetary instability, gold could easily double or triple from current levels. With stocks, the risk-reward is inverted. The upside is limited by expensive valuations and exhausted tailwinds. The downside is substantial. A return to historical average valuations would mean a 40 to 50% decline from current levels. This isn't about being pessimistic or bearish. It's about being realistic about where we are in the cycle and positioning accordingly. And right now, the cycle is screaming that gold is the safer bet. Think about your own financial situation. How much of your wealth can you afford to lose? If stocks fell 50% tomorrow, would you be okay? Would you still be able to retire when you planned? Would you still be able to maintain your lifestyle? For most people, the honest answer is no. They can't afford a major stock market decline, which means they're taking on more risk than they should be. And the solution isn't to just hope stocks keep going up. The solution is to allocate some portion of your wealth to assets that protect you when stocks don't go up. Gold is that asset. It's the insurance policy that actually pays out when you need it most. And unlike insurance, which costs you money every year, gold has the potential to appreciate significantly while providing that protection. The smartest investors in the world understand this. Ray Dalio has been vocal about gold's role in portfolios. Paul Tudor Jones owns gold. Stanley Druckenmiller has allocated to gold. These aren't gold bugs or conspiracy theorists. These are legendary investors with decades of experience and billions of dollars under management. When people at that level are buying gold, you should pay attention. They're not doing it because they read some article online. They're doing it because their sophisticated analysis of markets, monetary policy, and geopolitical risk tells them gold is essential right now. And here's the final piece that ties everything together. We're living through a period of monetary experimentation that has no historical precedent. Never before have all major central banks simultaneously printed money on this scale. Never before have we had global debt levels this high relative to GDP. Never before have we had this degree of financial interconnection and systemic risk. We're in uncharted territory. And when you're in uncharted territory, you want to own assets that have proven themselves over centuries, not assets that depend on everything continuing to work perfectly. Stocks require faith in the system, faith that central banks will manage things correctly, faith that governments will act responsibly, faith that the financial system will remain stable. That's a lot of faith to place in institutions that have repeatedly proven they're not infallible. Gold requires no faith. Gold is simply gold. It's been valuable for 5,000 years. And it will be valuable 5,000 years from now. That's not faith. That's historical fact. So when you're deciding between stocks and gold right now, you're really deciding between faith and facts, between hoping everything works out and preparing for the possibility that it might not, between following the crowd and thinking independently. The crowd is still in stocks, still believing the old narratives, still trusting that this time will be different. But the smart money, the central banks, the institutions, the legendary investors, they're buying gold. They're preparing for a different outcome. The question is, which group do you want to be in? The group that's hoping for the best, or the group that's preparing for reality? Because reality is showing us right now, with gold's historic rally and the structural problems in the financial system, that the safer bet isn't stocks anymore. The safer bet is gold. And the longer you wait to recognize that, the more expensive that recognition is going to be.